Okay, guys, Crypto 38 here, and we're gonna do a quick rundown here, my overview, the Bitcoin market, anything else that I might want to share with you here. And as you can see, I'm on the hourly chart here on Uni, but we're gonna go to the big dog. Big dog being Bitcoin, the king of everything. I'm gonna go to the daily chart. So, what we had here, for anybody that's panicking right now, was basically somebody, whoever that might be, decided to sell. Now that's the part of the game, right? You get in, you get out. When you want to get out, it's up to you. It's up to each individual person when they want to get out. Now, this is nothing bad. Some people view it as something big, and that's because Bitcoin tends to move very volatile, right? So basically, let's just say we was at the 20,000 level. And from the 20,000 level, we just shot up all the way up here to the 42,000 level. Okay, that's $22,000 in the Bitcoin price just shooting up like that, right? Then we had a small correction here. And at that time, when that correction happened, people were panicking too. I don't know why, because this happens in every market. It happens in the stock market. So, matter of fact, I have some stocks, and they shot up about 2 weeks ago. They shot up extraordinary. I mean, the prices shot up, right? And then the last week, it's just been crashing. So these things are normal in the market. You just have to be aware of that. And as long as you're aware that when it happens, you won't panic. Now, when I first started, I would panic myself. But now that I've been around for a long time, I don't panic anymore. I just know, you know what? This presents itself as a buying opportunity, as a way for me to add more money to my Bitcoin holdings, right? So we had the drop here and we had a consolidation phase. And this big candlestick that you see here is, of course, if I'm correct, if I remember correctly, when um when Tesla bought. Was that when Tesla bought, or was that over here when Tesla bought? I don't quite remember, but I think it was this big candle right here when Tesla decided to buy. Let me go down on the hourly chart, see if I can remember from here. Yeah, this big spike right here was the Tesla buy. And that was basically February 21st, around that range. So let's go back to the daily chart. Daily chart. This big candle here, when was it? February 21st. Yeah, so like I said, this was when Tesla bought. So you see this big spike up here. From there, continued to go up. We made it as high as like 58,000. And then, of course, we came back down. Now, that's natural. That's natural for that to happen. Okay? Any market, that's always going to happen. So that's nothing new. Now, for people that are trading, as I used to do, you just got murdered in that sell-off right there. If you had any stop losses here, you just got cut out. And that's very frustrating. And that's the reason why I don't even trade this anymore. What I do is I buy and hold, and when these dips um come like this, I just add more money. It's just better, because if you ever bought Bitcoin and hold and never sold, then you never lost money. Now, if you've been trading in and out, then it's a good chance you've lost money. My phone is over here listening to me. No, nobody's talking to you. Nobody's talking to you. So That's why I don't trade anymore. But if you look down here on the RSI, I'm always talking about the RSI. We was above 70 and it had to come down and correct. We didn't go all the way down under 30, but we came down. And then we went up on the Tesla buy. We went above 70 and then we was kind of like stuck around 70 and then just now we went above again. But then we came down. But as you notice, as we hit this indicator I have here, this is the 26 exponential moving average that I use, which is the same one that Coinbase uses. And Coinbase being one of the biggest or largest exchanges out there. As soon as it hit this, it bounced. And when you see something like that bounce, that's showing you that there's support. Now, an hour ago, this whole screen here on the right was completely red, even the stock market, completely red. Now we're green. We're green. And what's going to happen is all the people that sold are going to be upset right now because they're like, damn, why did I sell? And all the people that were trading and have stop losses, they're trying to get back in. That's why I don't trade Bitcoin anymore. I don't. I just buy, I hold, and when dips like this happen, I buy a little more. So I bought a little more at when it came down to like 52,000, because it came down all the way to 40, 44, 46 around there, right? And then it started coming back up. So then I bought a little more around 52,000. And then it actually went down a little even further. So I ended up buying again around 48,000. Okay, but this is perfectly normal. If you guys want to go check out a good YouTuber that I've been watching for years now, Cryptos Are Us, he explains why he believes that this sell-off happened and is linked between the F2 pool, which you've probably seen around on YouTube, and the fact that you got the Bitcoin's futures expiring on Friday. And basically, I'm not an economic expert, but that's basically dealing with more gambling, where you're gambling on what the price will be at the end of the month. And that's probably what's going on here. Now, what I say to people is the more people join the Bitcoin community and buy Bitcoin, the less volatile Bitcoin will become. In other words, more people start buying, more people are holding Bitcoin in their own individual wallets. And when these big whales decide they want to try to manipulate the market, whether it be up or down, that that effect will be less because more people are holding Bitcoin and there's only a certain amount of Bitcoin, and so they won't have the opportunity to really make the price go down anyway, because most people that are in this for the long run, they're not selling. So when those people shoot up the price like that and then bring it back down, they're trying to get the weak hands to sell because then they make a profit off of that, right? But everything is fine. If you can see, we're already having a bounce right here on this indicator, which I have, which is the 26 exponential moving average. Ethereum dropped down crazy too, but like I said many times before, Bitcoin goes down, everything goes down. The only one you really got to follow is Bitcoin until I see another cryptocurrency that's able to break away from Bitcoin's pattern, which is when it goes up, everything else goes up. Until I don't see that break, the main one I follow is Bitcoin. I know that if Bitcoin goes up, the rest of the cryptocurrency market is eventually going to go up. It might be a little delay in between, or it might be right there, right behind Bitcoin, but I know it's going to follow. I know that when Bitcoin drops, everything else is going to drop. So the main one I watch is Bitcoin. That's the only one I need to watch, okay? If I want to know when is the best time to buy another cryptocurrency, I just watch Bitcoin. When Bitcoin goes down, I know the rest of the crypto market went down, I'll go and buy that other cryptocurrency. Now, let's look at the hourly chart. As you can see on the hourly chart, we came down here under the RSI on the hourly. We dipped below it, we went up, we actually came back, dipped below it again, and now we're going up. So we're going back up already. We're probably going to hit up here to 52,000 where you see this 200-day yellow moving average, simple moving average. We might get a little resistance there, and then we're going to see what happens. But as of right now, there seems to be support around this $48,000 level. It's support. And that's why I said I bought in this area, 48,000, 52,000. I added a little more. I didn't sell anything. I just added a little more. Plus, it's if you want to go in and out the market, you're really doing yourself a disservice because of taxes. All right. So, you want to buy and sell, buy and sell, buy and sell. At the end of the year, when you got to report those taxes, it's going to be a headache to figure out what time you bought, what day you sold, how much you sold, how much you bought, right? It's going to be a headache. And then, of course, you're going to have to pay the tax, man, which is so frustrating to me. It's probably frustrating to a lot of people that here it is, I'm on my computer making some money, and somehow, some way I have to pay the tax man when they have a money printer over there or a computer where they just hit the keystrokes and create money out of thin air to buy war machines and send money across seas to other governments and stuff like that. Yet they want to take the little bit of money that I make on my own here, right? But that just goes to show you how governments work, right? The crypto market is green right now, so everything looking good. The Dow, I mean, let's look at gold. Look, gold is breaking back up. Silver is breaking back up. The Dow is breaking back up. The S&P 500. Now, we all know already that the reason that the S&P 500 stock market goes up has to do with the Federal Reserve's buying of assets, right? We all know that's what's happening. So that's what's keeping the market up. This is why I hate when people criticize Bitcoin and say, oh, the Bitcoin, it only goes up when people buy it. And if nobody buys it, then Bitcoin's not going to. Well, guess what? The stock market would have crashed a long time ago if the Federal Reserve hadn't stepped in and started buying all the assets. And how do they buy all the assets? Easy. They go on a computer, they type in, I need $500 billion. They go and buy these assets, and now that money floods into the system. And of course, that creates inflation. And of course, that money usually tends to go to people who already have money. Because I can go into the bank and they're not going to give me a loan. They're not going to give me a $50,000 loan. I have to pass all these checks in order to get that loan. Where do I work? How long I've been working there? What's my credit score? All types of things. Meanwhile, you got these companies who've probably been convicted or caught doing some type of fraud who are crashing, and here they go and they ask the Fed for some money, and the Fed says, okay, fine, we'll give you some money, right? Then they give the banks the money, and all these bonds that these people have, they're getting it at zero interest rates. And so it's a win-win situation for them. Meanwhile, when a little person like me needs money, I have to go directly to the bank, and then the bank is going to charge me this enormous interest rate. And of course, I probably won't even get the loan in the first place because I don't meet the qualifications, right? And that's how the system works. So the system is in no way meant to benefit little people. It's only meant to benefit those who already got money, right? So what else we want to look at here? The dollar. Of course, this is what I use every day, the US dollar. Let me take a sip here. I don't know if I can display that, so that's why I covered it. But US dollar is still going down. Let's look at the daily chart. So the US dollar, the currency, is actually a liability, which I just learned. So it's a liability, and every time the Fed buys up assets like treasury bonds, whatever types of bonds, and corporate debt, they give you dollars, which is a liability, and what they take in is considered an asset. So imagine that. You think you think when you get dollars, that's a good thing. In reality, when they give you dollars, you're taking on a liability. And in economics, you never want to have liabilities. You want to have assets, brother. Federal Reserve gets all the assets, and then the funniest part about it is that they got it for free because all they did was just type in the computer, I need this amount of money, and they got it. So the U.S. dollar continues to do bad, right? Back to Bitcoin, everything doing good. We had 49,940. About an hour, 2 hours ago, we was at 48,000. We're already at 49,400. Now I'm watching Uni. Now let me tell you something about Uni that I dislike. I got the 400 Uniswap tokens for free. It's a blessing. It's definitely a blessing because I actually use the money to pay off bills because I don't have a job. I lost my job during the pandemic. I've been living off of my cryptocurrencies. Basically, the government doesn't want to help me. I don't qualify. All types of you know qualifications you need just to be able to get some money to go buy, pay bills, and buy food. Right. So I've been living off my cryptocurrency. So they gave me Uni token. Now I'll tell you what the problem is. When you go on Uniswap and you want to convert this Uni token into your stable coin, so then you can send the stable coin to Coinbase, so then you can sell it on Coinbase, so then they could deposit it on your bank account. It's too expensive. It's way too expensive. Why would I want to do that? Nobody that gets into cryptocurrency is going to want to pay $100 in gas fees. Okay, and that was the latest when I checked. The first time I took out $500, they charged me, I think it was about $40 to take that $500. Then later on, I decided to take out about another 100 of Uni tokens, and at that time the price was higher, and they charged me, I think it was almost like $60 in gas fees. Earlier today, I was going to take out some more Uni tokens, and they wanted to charge me $80 in gas fees. That's outrageous. It's outrageous. I don't want to pay $80 in gas fees. That's outrageous. That's not what crypto is supposed to be about. Cryptocurrency is supposed to be about me paying less. Because if not, for that, I just keep using Western Union and the bank and all of them because they're not charging me $85 to make a transaction. They're charging me $15. Right? Because when I transfer my stable coin from Coinbase into my bank account, Coinbase charges me $15. Bank charges me $15, right? But it's way less than $80. So that's one thing I noticed about this Uniswap thing that's going on. So I'm gonna have to try something else. I heard Pancake Swap is way less in fees and way better. I will have to see if I can qualify for that. I was living in New York City about a month ago, and New York City is very strict with regulations, and they don't allow you to buy just about anything. You have to buy whatever they tell you to buy, and the reason they do that is because they have their select group of people who are going to benefit from all that because they're basically creating a monopoly. When they tell you, listen, you can't buy from her or him, you can only buy from him, they're basically creating a monopoly. Okay, because then I can only go to him, I can't go to nobody else. The competition is right away cut off, so there's no free market in any of this. So now that I'm living in a different state, I'm hoping I'm allowed to invest, in which I am because I already changed my addresses on a lot of these exchanges, and they already told me yes, you are allowed to buy other cryptocurrencies, although it's not completely a green light all across the board. But I'm glad that I moved because now I get to invest a little more. New York City regulations are just too crazy, and that's just because they want to corner the market. They only want certain people to make all the money, and that's the way things work around here. Okay. So Uniswap gas fees outrageous. I don't think once as a newcomer they start coming in, they start realizing, listen, I have to pay $100 just to convert my cryptocurrency from one to another. Nobody's gonna want to do that. So with that being said, unless Uniswap becomes an exchange for the rich and wealthy, ain't nobody going to continue to use that in the future. Why would you want to spend so much money in converting your cryptocurrencies? I know I wouldn't. So once I take out my last little bit free tokens that they gave me here on Uniswap, I won't be using Uniswap anymore. So I'm going to try out PancakeSwap. Once I start getting into PancakeSwap, I could do a video, let you know what's going on. Right now, I'm disliking what's going on with Uniswap. Everything else pretty good. You know, Atom doing good. Everything, you had this big drop and nothing really went anywhere. The Nexo token dropped because everything dropped, but everything stood basically the same price, and that's why I say it's just better to buy and hold. We're already up to 50,000. Okay, we're gonna be right back up to 60,000 in no time, and that's when people are gonna be like, "Oh man, I should have just bought, hold, and that's it." And all the people that sold are gonna be kicking themselves in the butt, saying, "I don't know why I sold." I'm not gonna be doing one of these. I've done it myself. It makes no sense. It's just better to buy, hold, and wait your turn, right? You got people that invested in this way ahead of me, and they've been waiting for years, and maybe they want to take profit and it's going to bring the price down. But guess what? They was waiting for a long time. I just got into this. I got to wait my turn as well. So that's the only thing that's happened. Other than that, if I want to share with you, maybe you want to check out this here. I was looking this up here on the Fed's tool for influencing the economy. And this was interesting to me, because look what it says here. Everybody always talks about the free market, the free market. There's never been a free market. The market has always been regulated, and you only been allowed to buy and sell wherever they told you. Let me take a sip here and I'm gonna cover this. But look what Investopia says, and this is really good. It says, left to their own devices, free market economies tend to be volatile as a result of individual fear and greed, which emerges during periods of instability. In other words, you can't have a free market, because what happens when you have a free market? People get greedy. Okay, and we've seen that all throughout history. I remember Andrew Carnegie, one of the titans of America, used to work his workers 7 days a week, and he only gave them 1 day off of work, and that was, I believe, New Year's Day. Other than that, you was working 7 days a week. Okay, capitalists, because we live in a capitalist society, never want to raise their workers' wages, right? As soon as the government speaks about raising people's wages, what happens to the employers? No, we can't do it. We're gonna go bankrupt. We're not gonna be able to pay them this amount of money. So if it was up to the capitalists, you would never get raised. The reason we get raises is because the government steps in and passes a law that says you have to give these people a raise. And this is why I find this first statement here in the paragraph. Left to their own devices, free market economies tend to be volatile as a result of individual fear and greed. Now, with the U.S. Fed, all this bond buying, they've been buying billions and billions of dollars in bonds, asset purchases. And they've been doing that since 2008. It's not like the pandemic made anything new. The only thing that the pandemic accelerated their buying process. But it says the U.S. Federal Reserve exists to maintain a stable and growing economy through price stability and full employment. It's two legislative mandates. Now, that full employment thing, I think it's full of crap. Because if the U.S. government really wanted to have full employment, just the way that they print money out of thin air to make war machines and give governments across seas millions of dollars, they can do the same thing and do just like China does, which is all that money they use, go build bridges, go build houses, go build infrastructure, pay the people, but they don't. What they do with the money, the Fed prints it, buys asset, gives it to the banks and the corporations, and those people tend to buy back their own stocks, tend to hoard that money, use it for themselves, right? But it never goes into the economy, into the infrastructure, which is the reason why Texas right now is falling apart, right? So, those are the facts. All this free market stuff capitalists want to tell you is just complete fraud. So it says historically the Fed has done this by manipulating, what kind of word we're getting into here, short-term interest rates, engaging in open market operations, and adjusting reserve requirements, right? And if we go down here, manipulating interest rates. The first tool used by the Fed as well as central banks around the world is the manipulation of short-term interest rates. Put simply, this practice involves raising, lowering interest rates to slow, spur economic activity and control inflation. The mechanics are relatively simple. By lowering interest rates, it becomes cheaper to borrow money and less lucrative to save, encouraging individuals and corporations to spend. Now, in my world, I don't know what world other people live, but I live here in the United States. It's all about spending. This is why there's always ads everything you see, everywhere you go. People are always trying to sell you something, an advertisement, so you can go and spend money. And that's because they need you to spend money in order to keep this cycle going. Because if everybody in the United States just stopped buying, the whole economy just completely collapsed. We live in a debt-driven society. Therefore, they need you to keep spending, keep using your credit cards in order to keep things moving along. So, as interest rates are lowered, savings decline. More money is borrowed and more money is spent. So that's the reason they do it. They lower the interest rates so that more people can take loans out. Now, the problem with more people to take loans out, as I said before, only certain qualified people are going to get the loans. And those are the people who usually already have money, right? A guy like me is not going to get a $50,000 loan. I have no job because of the pandemic. I'm not going to get a $50,000 loan. And a guy who goes in there who already has money, has houses and everything, he's going to get this loan immediately and he's going to get it for zero, probably negative, right? And so he's making a killing. Then what they do is all his money goes into the banks, and then the banks charge you an interest rate. So the banks get it for free, basically. But then when I step into the bank, I have to pay this high interest on this loan that I get. And it's always a loan. Can't just be given to me, right? Just like they give it to the army to build war machines and bombs and give it to for whatever it is they're going to use. It always has to be a loan paid back. I don't understand that in life if you really think about it. If you're the government and you make the money and, you know, if I need a house, I can work, you can put people to work and we can all work together to build everybody a home where they can live and have a car and everything like that. In reality, there's really no need to have an economy. All you just need is to build the stuff. And the government says, here, this is what we're going to use for you to get your house and your car and everything. Because they have the guns, right? Just like they do now. I don't know. Maybe I'm just crazy. Um, so it says, on the other hand, lowering interest rates also tend to increase inflation. This is a negative side effect because the total supply of goods and services is essentially finite in the short term, and with more dollars chasing the finite set of product, prices go up. So basically, they're saying is when they lower the interest rates, people take out more loans, they have more money, now they go out to buy more stuff, and then they take everything off the shelf. So when you go to Best Buy, all the TVs are gone. When you go in the supermarket, all the meat is gone. And that's because people have so much money that they're buying everything up. And now the prices are going to start to go up because they're going to be like, wait a minute, we don't have enough here, so we're going to have to make the prices go up. Basically, that's what they're saying there. It says, therefore, the trick with interest rate manipulation is not to overdo it and inadvertently create spiraling inflation. This is easier said than done. Now, open the market operations. The other major tool available to the Fed is open market operations, which involves the Fed buying or selling Treasury bonds in the open market. That's what they've been doing now, especially during the pandemic. They've been billions and billions of dollars. They're buying the Treasury bonds and whatever other type of bonds that they have. They started buying corporate bonds, which I believe that's the first time in history they did that. It says if the Fed buys bonds in the open market, it increases the money supply in the economy by swiping out bonds in exchange for cash to the general public. Conversely, if the Fed sells bonds, it decreases the money supply by removing cash from the economy in exchange for bonds. Therefore, OMO has a direct effect on money supply. right? Reserve requirements. Federal Reserve also has the ability to adjust bank reserves, meaning it tells the banks, listen, you got to have a certain amount in there all the time. Now, if we go to this next one here, so basically the tools they say the Fed has. Understanding the Federal Reserve balance sheet. There's something in here that I found interesting. And it says the Federal Reserve System is the central bank of the United States and is responsible for the nation's monetary policy. The Fed's primary goals are to promote maximum employment, stable prices, and manage long-term interest rate. And they use various programs to accomplish this. Just as the balance sheet, just like any other balance sheet, the Fed's balance sheet consists of assets and liabilities. Each week, the Fed issues its H41 report, which provides a consolidated statement of the condition of all the Federal Reserve banks in the terms of their assets and liabilities. Now, this is what I find interesting here. For It says for much of its history, the Fed's balance sheet was actually quite a sleepy topic. Each and every Thursday, the weekly balance sheet report includes items that might seem at first glance typical of most company balance sheets. It lists all assets and liabilities. The Fed's assets consist primarily of government securities and the loans it extends to its regional banks. Its liabilities, now listen to this, include U.S. currency in circulation. That means the U.S. dollar, that paper money that you're holding in your wallet right now. Now, that was surprising to me to find out that the money that I hold in my wallet is actually considered a liability. And that's what you don't want to have is liabilities. You want to have assets. Let me take a drink here. So it says the weekly balance sheet report became popular in the media during the financial crisis. That's when, everybody started watching what was going on. The Fed's assets. The essence of the Fed's balance sheet is similar to any other balance sheet since anything for which the Fed has to pay money becomes the Fed's assets. In other words, if the Fed were to hypothetically buy bonds or stocks by paying newly issued money for it, that's the key, by paying newly issued money. Type it into the computer, voila, it comes to an existence. Those investments will become assets. Now, what do they get? Treasuries, right? Traditionally, the Fed's assets have mainly consisted of government securities, such as U.S. Treasuries and other debt instruments. So basically, the U.S. Treasury or the Congress, it was my phone listening to me again, right? Like nobody's talking to you, nobody's talking to you, nobody's touching you. So basically, such as the U.S. Treasuries, the Treasury, if I understand this correctly, the U.S. government prints out a piece of paper. They print out a piece of paper out of their printer. They write on it, yeah, this is gonna be a treasury worth $2 million. Then they hand the piece of paper over to the Federal Reserve, and the Federal Reserve turns around and gives them cash. Now that cash is injected into the economy. That's all it is. They just transfer paper to paper to paper to paper. Right? That's all it is. So it says more than 60% or 4 trillion of the 7.34 trillion in assets include various types of U.S. Treasuries as of January 7, 21. The Treasury Securities include Treasury notes, which have maturity dates that range from 2 to 10 years, and Treasury bills or T-bills, which have short-term maturities such as 4, 8, 13, 26, and 52. Another thing that they buy are mortgage-backed securities, which are investments that are made up of basket of home loans. These fixed income securities are packaged and sold to investors by banks and financial institutions. It says the Fed owns more than 2 trillion in this. Then you have loans. The assets also include loans extended to member banks through the repo and discount window. So overnight, banks lend money to each other. And when they don't have enough money, they go over to the Fed, knock on his window, and say, listen, we need $1 million and we'll pay it back tomorrow morning and give you interest for it. And then the Fed says, okay, we'll give it to you They don't really hand out no cash unless they specifically request for the cash. What they do is they just type it on the computer. It's in the other bank's uh, account. So those are some of the things the Fed buys. Now listen to the Fed's liabilities. One of the interesting things about the Fed's liability is that currency in circulation, like the green dollar bills in your pocket, are reflected as liabilities. Interesting. Interesting. Stuff my employer gives me every week is actually a liability. Apart from this, the money lying in the reserve account of member banks and U.S. depository institutions also forms a part of the Fed's liabilities. As long as the dollar bills lies with the Fed, they would be treated as neither an asset nor liabilities. The dollar bill becomes the Fed's liabilities only when the Fed puts them in circulation by purchasing assets. So all these assets that the Fed has been buying every single day in the billions for the last, I don't even know how long, but I know they've been, from when I've been watching it, they've been doing it for about 3 years now. They've probably been doing it since 2008, right? Of the nearly 7.3 trillion in liabilities as of January 7, 2021, the Fed had just over 2 trillion as currency notes and nearly 5 trillion deposits on its balance sheet. The size of different components of the Fed liabilities keeps on changing. For instance, if the member banks wish to convert the money lying in their reserve accounts into hard cash, the value of the currency in the circulation would increase and the credit balance in reserve accounts would decrease. But overall, the size of the Fed's liability increases or decreases whenever the Fed buys or sells its assets. The Fed also requires commercial banks to hold on to a certain minimum amount of deposits known as reserves. The meaning of liability. The Fed can very well discharge its existing liabilities by creating additional liabilities. For instance, if you take your $100 bill to the Fed, it can very well pay you back in five $20 bills or any other combination you like. The Fed cannot in any manner be compelled to discharge its liabilities in terms of any other tangible goods or services. At best, you could receive government securities by paying back in dollars whenever the Fed is selling. Right, so it's interesting to know that the stuff my employer that I work hard for 50 hours a week is actually a liability. Fed's expansion, quantitative easing. It's an unconventional monetary policy, which means it's just something that they came up with out of nowhere. Monetary policy in which a central bank purchases government securities or other securities from the market to lower interest rates and increase the money supply. Using the Fed's balance sheet through quantitative easing remains somewhat controversial. Although these efforts certainly help ease the bank sector's liquidity issues during the financial crisis, critics contend QE was a giant drawback and was a distortion of the free market principle. Today, markets are still sorting out the short-term bump but longer-term side effects. And then what you have here is a graph of the Fed's balance sheet of all the stuff they've been buying. So they've been buying Treasury Securities. That's that piece of paper that the U.S. Congress decides, yeah, here you go, we're going to give you this piece of paper, $5 million here, and then the Fed gives them $5 million when they type it into the computer. They've been buying gold, of course, the gold stock, Treasury securities, inflation compensation, federal agency debt securities, mortgage-backed securities, net unamortized premiums on securities held outright, repurchase agreements, loans, net portfolio holdings, all that stuff is just basically pieces of paper where they just write stuff on and say, yeah, look, this is worth $10 million here. Give it to me. And then the Fed types it up, right? Magical money, like the Wizard of Oz. And there you go. They have free money. So what else we got here? Anything here that I seen that I thought was interesting in this article? No. So let's move on to the next one. The bonds. So it says issuing bonds is one way for companies to raise money. A bond functions as a loan between an investor and a corporation. The investor agrees to give the corporation a certain amount of money for a specific period of time. In exchange, the investor receives periodic interest payments. When a bond reaches its maturity date, the company repays the investor. So the Federal Reserve has become the investor. The problem is that the Federal Reserve, as playing the role of an investor, gets to just type up the money on the computer and poof. Understand? It's way different from me, where if I want to become an investor, I actually have to have the money. Like, I can't become an investor without money. Let me take a sip here. Whereas the Federal Reserve just types it into the computer, poof, it appears. Now, he goes, he gives these companies cash, and in return, he takes this piece of paper, right, that he holds on to. And then when that company finally makes the profit, which most and a lot of times companies don't even make profit, they just stuck and they have to get more debt and more debt and more debt because that's the society we live in. But anyway, let's say that company does become profitable and now he pays back the interest to me, right? Because I gave him cash for it. I don't necessarily give him this paper back. If anything, I just get interest on it because that's what I'm going to make money on, right? So it says the decision to issue bonds instead of selecting other methods of raising money can be driven by many factors. This one here that I seen was interesting. This one here, very interesting. Bonds versus banks. Borrowing from a bank is perhaps the approach that comes to mind first for many people who need money, right? All us little people out here, when we need money, we have to go to TD Bank, we have to go to Chase Manhattan Bank, we have to go to Wells Fargo Bank, we have to go to Banco de Ponce de Leon, right? We have to go to all these banks to get the money. The problem is you got to meet all the qualifications, and they're always going to charge you this high interest. Meanwhile, the bank itself got the money at zero interest rate or negative interest rate, meaning they got it practically for free. But then they're going to turn around and charge you an interest rate on it. So it says, that leads to the question, why would a corporation issue bonds instead of just borrowing from the bank? So if I own a beer company and I need cash, why don't I go to the bank? Why do I go to the bonds? Well, that's because it's cheaper to get the bonds. But not everybody can get a bond, right? You got to meet the qualifications, like as I said already. You got to have the money. You got to have the credit score. You got to have the good job. You got to have the collateral. So it says, like people, companies can borrow from banks, but issuing bonds is often a more attractive proposition. The interest rate that companies pay bond investors is usually less than the interest rate available from banks. So the suckers here are the little people here. We're getting suckered. Companies are in business to generate corporate profits. Yeah, trust me, I know that. This is capitalism. So minimizing the interest is an important consideration. That is one of the reasons why healthy companies that don't seem to need the money often issue bonds. The ability to borrow large sums at low interest rate gives them corporations the ability to invest in growth and other projects. So this is what they're saying. They don't even need the money. Let's see it. That is one of the reasons why healthy companies that don't seem to need the money. So they don't need the money, but because they have all the credentials that they need, they can walk over, get these bonds at zero interest rates, and then take that money and do whatever it is that they want to do with it, whether it be buy back their own stocks, so then the CEOs get this great bonus, whether it be to buy another 200 properties, so then they can go and charge everybody in that unit rent, and they just sit at home and collect more money, right? They can buy a yacht. They can do so many things with it, whereas us little people, we can't do none of that because we don't fit the credentials, right? The ability to borrow large sums at low interest rates gives corporations the ability to invest in growth and other projects. Issuing bonds also gives companies significantly greater freedom to operate as they see fit. Bonds release funds from the restrictions that are often attached to bank loans. For example, banks often make companies agree not to issue more debt or make corporate acquisitions until their loans are repaid in full. Because if I go to a bank, I got to finish paying that whole loan off before I can get another loan, or if I never pay it back, my credit score, everything will be messed up. So, but with bonds, they're basically saying when the company, which is happening today with a lot of these companies, they get a loan, they don't make any money, they're still in the hole, but they can come back and get another bond, right? Whereas if they would have went to the bank, they would not be allowed to do that. But again, the banks take advantage of us little suckers, right? Such restrictions can hamper a company's ability to do business and limit its operational options. Issuing bonds enables companies to raise money with no strings attached. Stocks, bonds versus stocks. Issuing shares of stocks grants proportional ownership in the firm to investors in exchange for money. That is another popular way for corporations to raise money. From a corporate perspective, perhaps the most attractive feature of stock issuance is that the money does not need to be repaid. Don't they love that? They are, however, downsides to issuing new shares that may make bonds the more attractive proposition. It says companies that need to raise money can continue to issue new bonds as long as they can find willing investors. As long as somebody's willing to give me the money, I can continue to write on this piece of paper here $5 million, and as long as they give me the money, I can keep doing it. Whereas I went to a bank, I wouldn't be allowed to do that, right? So it says stock issuance, on the other hand, puts additional stock shares in circulation. That means future earnings must be shared among a larger pool. Wow, we really don't want to be shared those $500 billion I made this year. More shares can cause a decrease in earnings per shares, putting less money in owners' pockets. Yeah, trust me. EPS is also one of the metrics that investors look at when evaluating a firm's health. So, of course, you have all types of bonds. And as far as this one, I think that's it. So, I thought all that was interesting. Of course, it says here Federal Reserve said Friday they purchased 1.3 billion in corporate bonds in late June. This is an old article. I'm just trying to show you. The Fed bought bonds issued by several hundred large companies, including AT&T, PepsiCo, Berkshire Hathaway, the conglomerate controlled by billionaire Warren Buffett. Combined with purchases from earlier in the month, the Fed has bought nearly 1.8 billion in corporate debt. Now, what I'm trying to figure it out, for example, people like Warren Buffett, this guy has so much money. Why in the world would he need more money from the Fed? Why? Well, because he's getting it at zero interest rate. It's basically free money. So AT&T is getting free money. PepsiCo is getting free money. And if you notice, the people who get the free money are usually the American companies, right? Because, of course, it's capitalism. It's all about, America being in control, even though their economy is not doing as good anymore. China is the top dog now, but they want to try to maintain that hegemony, that imperialistic, economy where they control everything, and so they're trying to look out for their people. And these companies would have been bankrupt. They would have just been gone long many years ago if it wasn't for the Fed giving them free money, right? So it says the purchases are intended to keep interest rates on corporate bonds from spiking, which would make it harder for companies to borrow by selling debt. The Fed's announcement in March that it would, for the first time, purchase corporate debt quickly boosted trading in corporate bonds and brought down interest rates in the market. Key word, quickly boosted trading in corporate bonds. Because when the Fed goes on TV and tells you, listen, I'm going to start buying all these companies' bonds, then the person who has money says, "Whoa, well, I'm going to go buy shares of AT&T or bonds or a PepsiCo or Berkshire Hathaway because I know that as long as the Fed is buying it, the price is going to go up and therefore I'm going to make money." Right? The Fed is buying bonds from a wide range of companies to mimic a broad market index in order to avoid favoring any specific industries. They're trying to say they're trying to buy from a little bit from everybody so people won't complain. The reality is For what I understand, the Fed buys a lot of stuff that they don't reveal who they're buying from. Might be wrong about that, but it says last month it bought bonds issued by UPS, Home Depot, oil and gas pipeline company Kinder Morgan, and drugstore chain CVS. If it wasn't for the Fed doing this, all these companies would go out of business. They wouldn't have no money. It says the Fed has also purchased nearly $8 billion in pools of bonds held in exchange traded funds, which operate similarly to mutual funds. So that's interesting there. Now, what else we got over here? But you can see the problem is that all this Fed buying um, only helps the
Matthew
wealthy
Cratter from
around,
Trader University.
right?
And
Because,
today I want to talk
sorry,
about why.
sorry about this. I'm getting another drink here. I was watching Michael Saylor. Let's check real quick on the Bitcoin price. I was watching Michael Saylor speak the other day in an interview. And he said the Fed can pretty much just, all that money that they're doing, instead of going buying assets, they could be sending it directly to everybody's checking account. And what will we be doing with it? God forbid, we'll be paying our bills. We'll be paying our rent. We'll be paying down our credit cards, right? Bringing down our debt. Paying our car loans off, paying off whatever loans we have, right? So that would actually help us. But as Michael Saylor said, they don't want that. Instead, what they do is they print all this money, they buy all these assets, and it goes straight into the corporations and the banks. And then what do those people do with it? The same thing they always do with it, which is they buy back their own stocks, raising the stock prices go up. This way, the CEOs later on get these big bonuses that they can take out from that price going up. They go and buy real estate. I was watching this one guy on TV where he said he was looking around and he was trying to buy 200 more real estate properties. I just looked around. I said, like, what? He's trying to buy 200 more? Why in the world would anyone need 200 million real estate properties? Why do you need so many real estate properties to survive? You don't. You need one house to live in, maybe two. That's it. Why do I need 500? Well, that's because they're buying everything up because they can, and then they're renting it out to people where people would have to rent because they can't afford houses because you got to put 20% down now on a house. So that means if you buy a $300,000 house, you got to put $60,000, and then you got to pay the closing fees. That's another $15,000. And who in the world has $75,000 to start off with to buy a house? Nobody. We live in a debt society, right? So I want to put this little video here because watch who the Fed
Why
has
the Federal
every time they buy.
anonymous account on Twitter, but they did some very, very good analysis about what are the constituents in these junk bond ETFs.
I'm freezing up here.
So I thought I'd just quickly go through some of them to give you an idea of who we are bailing out by debasing the U.S. currency, by basically picking your pocket and mine, destroying our savings, destroying the purchasing power of the U.S. dollar. Who's benefiting? We'll start with Bausch Health. They have junk bonds that are in these ETFs. They used to be called Valiant Pharma, company that committed fraud and has fallen on hard times. Obviously, has to issue junk bonds at this point. The next one we'll cover is an Italian bank. The Fed is actually helping to bail out this Italian bank by propping up their debt. This is called Intesa. Next, a French telecom operator, highly leveraged company that's had a lot of problems, has to issue its debt in the junk bond market. So we're actually helping out the ECB here, the European Central Bank.
And a lot of internet problems now, huh? Just when I'm doing my
and we're
videos.
helping out. Again, these are private companies or publicly traded companies that your and my dollars are bailing out. Next, PetSmart. PetSmart, obviously, pet food, pet store. They went private a couple years ago as as part of a private equity deal. So we're actually helping private equity firms as well by propping up PetSmart. Hardly something to be considered something that's essential to the health of human beings or really the U.S. economy. Uber. Uber has some bonds in these ETFs, and so they are also receiving a bailout. And the fact that they have to issue junk bonds should tell you junk bonds are actually ahead of the equity. So it tells you how dangerous it is to hold the stock of Uber. Next, we have Netflix. Netflix, obviously, we've all been enjoying quite a bit lately. It doesn't seem fair, though. It doesn't seem essential to the economy. If Netflix needs to raise more money, they should sell more shares of stock. But we really shouldn't have the Federal Reserve buying Netflix bonds, especially when the CEO is a billionaire, $4.2 billion. Carl Icahn, very famous finance guy, he has 6 different companies that have bonds in this ETF. And so we're helping to prop up his empire. Carl Icahn, net worth of about $14 billion. Finally, of course, you knew it would be here. Tesla junk bonds also being propped up by the Fed buying. So you got to hand it to Elon. He's always there to collect government subsidies. And government subsidies right now exist mainly for billionaire holders. This is not something that is helping Tesla employees. They're still slashing employee pay. They're furloughing employees. And they just announced on CNBC this morning that Tesla is also not paying its rent. So hurting landlords. At the same time, they're getting this government support by the buying of their bonds. Just to remind you, Elon Musk, $32 billion net worth. Meanwhile, while this is all happening sort of in the finance economy, JP Morgan just raised their borrowing standards if you want to get a mortgage from them. Now you'll need to put at least 20% down and have a credit rating of over 700%. I'm sorry, a FICO score of over 700. This at the same time, if you want to pretend that Boeing is like a consumer borrower, Boeing is basically junk as well. They're allowed to borrow billions, and I believe their bonds are in these ETFs as well. And so I thought this was a great meme. Boeing, can I please have $50 billion? Easy to print out money for them. Average consumer, can I please have $2,000? Printer broken. And it turns out it's going to be more like $1,200, and not everyone's going to get it. So the difficult thing about the market today.
So, reflecting on everything we just went through about the Fed buying, purchasing, and all that, and that little bit there on that video, you can see that all that Fed buying assets, money printing, cash going into the system is going to those who are already wealthy, those who are continuing to get richer and richer, and that's why the income and inequality gap in America continues to grow. And this is all being done under capitalism, because you hear all this crap about socialism is so bad and that we shouldn't have socialism, but in the meanwhile, capitalism is the same way, right? And so this is why I'm into Bitcoin. This is exactly why I'm into Bitcoin, because I feel like Bitcoin is different. I really do. Bitcoin is different. And if I would have had my money in my TD checking account, my little $1,000, I still have $1,000. Meanwhile, I put $1,000 into Bitcoin, and that $1,000 is like $8,000 already, right? It depends where you bought it at, but I'm just giving you an example, right? I got Bitcoin credit that's more than TD Bank ever gave me. I applied for a raise on my credit card from TD Bank about 3 times because they only give me $1,000, and each time I asked, they denied it. Meanwhile, right now I have a Bitcoin credit line of, I think I'm up to like $6,000 on my Bitcoin credit line, and I can actually increase that if I wanted to. I'm just, like to have my money in different wallets. I don't like to put everything in one basket. But that's why I'm into Bitcoin, because the Federal Reserve System is kind of like the Wizard of Oz. When Dorothy goes back of the curtain, and the Wizard of Oz is right there, and I am the great Wizard of Oz, right? That's the Federal Reserve, yeah, the Treasury, right, the ECB, right, and they want to tell you that everything else is bad and their system is good. Meanwhile, their system only helps them and benefits them, but yet I have to pay high costs in health insurance. I have to pay high rent, right? I don't have a job right now. I'm living off of cryptocurrencies right now, right? If it wasn't for crypto, I'd be completely broke right now, right? But this is the system we live in. So anyway, that was my bit on Bitcoin. Everything is good. No need to worry about it. If anything, Bitcoin dips. What I do is, because I'm not a financial advisor, but what I do is I buy a little bit more, and I only buy what I know that if I lose, it won't mean nothing. It'll be like me spending a week in buying alcohol, right? Because the government has no problem me getting drunk. So I'll spend that money. That way, if I lose it, oh well. But I tell you this: anybody that has ever bought Bitcoin and never sold has never lost money. It's only when you trade and you get in and out the market that you're going to lose money. But if you buy and hold for long term and just wait your turn, you're going to be profitable. And that's my little 2 cents here on Bitcoin. Please enjoy the rest of your day. Crypto 38. Make sure you check out my website, crypto38.com. You guys want to purchase Bitcoin, earn interest on Bitcoin, buy a hardware wallet. Don't be afraid to ask any questions. Enjoy the rest of your night.